Welcome to EduWap, your one-stop solution for e-learning.
Chapter 8 of Module 5. Currency Convertibility. Question 6 will be from this module. 1. Introduction. 2. Types of currency convertibility. 3. Prerequisites of currency convertibility. 4. Merits of currency convertibility. 5. Convertibility of Indian rupee. 6. Foreign exchange reserves. 7. International reserves. 8. International monetary funds. 9. Special drawing rights. 10. Exchange risks. 11. Global linkage of foreign exchange market.
Introduction. When foreign currency is said to be readily exchanged for other currencies. Types. 1. Convertible currency. Can be converted into foreign currencies. Partial convertibility. Current accounts of BOP are convertible. Full convertibility. Current and capital account of BOP are convertible. 2. Controlled currency. Cannot be converted in foreign currencies.
Current account. 1. Trade account. Import and export. 2. Service account. Individual professional service. Institutional services. 3. Unilateral account. Gifts, donations, charities, grants, etc. Capital account. 1. Short-term capital movements. Buying and selling of government and corporate securities. 2. Long-term capital movements. Buying and selling of shares and debentures bonds. 3. Repayments of loans. Loans taken from developed countries or financial institutions.
Prerequisites for making the convertible system a grand success. 1. Stability of an economy. 2. Adequate stock of foreign exchange reserves. 3. Restrictive imports when foreign exchange reserves are inadequate. 4. Comfortable current account position of BOP. 5. Appropriate industrial and investment policies. 6. Export-oriented planning.
Merits of convertibility. 1. Encourages exports. 2. Increases profitability of exports. 3. Leads to import substitution. 4. Export promotion. 5. Incentive to NRIs to remit funds. 6. Assigns real value to currency.
Convertibility of Indian rupee. 1. Current account convertibility. 2. Capital account convertibility. 3. Terms for CHC. 4. Committee report on CHC. 5. Recommended preconditions for CHC.
Current account convertibility. 1. 1st of March, 1992, partial convertibility of INR was announced. 2. It was announced to make foreign exchange available at low price for essential imports. 3. It was announced as an experiment before full convertibility was announced. 4. Risk of introducing full convertibility due to heavy deficit in current account. 5. 60% of the foreign exchange earnings to be converted as per free market rate. 6. 40% of the foreign exchange earnings to be surrendered to RBI.
Capital account convertibility. 1. Freedom of converting local financial assets into foreign financial assets. 2. Introduced after partial currency convertibility. 3. Introduced only after experimenting with partial convertibility. 4. Helps to increase the inflow of foreign capital. 5. Enables the foreign investors to invest wherever they want. 6. Leads flight of capital from the country if domestic conditions are unfavorable. 7. Introduced only after experimenting with partial convertibility. 8. Enables residents to gold internationally.
Terms for CAC. 1. To review the international experience in relation to CAC. 2. To indicate the preconditions for introduction of CAC in India. 3. To recommend the measures that should be taken to achieve full CAC. 4. To specify the sequence and time framework in which CAC is to be adopted. 5. To suggest domestic policy measures. 6. To suggest changes in institutional framework for the success of CAC. 7. To make some other recommendations as the committee may feel relevant.
Committee Report on CAC. 1. Freedom to convert local financial assets into foreign financial assets. 2. Changes of ownership in foreign or domestic financial assets and liabilities. 3. Embodies the creation and liquidation of claims on or by the rest of the world. 4. Imposition of monetary and fiscal measures of foreign exchange transactions is excluded. 5. Availability of larger capital stock to supplement the domestic resources. 6. Improves access to international financial markets. 7. Allows residents to hold an internationally diversified portfolio investment. 8. Reduction in the vulnerabilities of income streams and wealth. 9. Lower funding costs for borrowers and higher prospects for yields to savers. 10. The qualities of financial assets will improve. 11. Greater liquidity and widening and deeding of markets. 12. Strengthens the conduct of monetary policy. 13. Realistic and appropriate exchange rate policy. 14. Enhances the effectiveness of fiscal policy. 15. Optimal combination of taxes following the international level of taxes. 16. Reducing craning out effect in the access to funds. 17. Canalizing capital flows into productive investment.
Recommended preconditions for CAC. 1. Fiscal consolidation. 2. Mandated inflation rate. 3. Strengthening of financial system. 4. Adequacy of foreign exchange reserves. 5. Good foreign exchange rate policy. 6. Sound balance of payment position. 7. Removing market segmentation. 8. Uniform treatment of resident and non-resident liabilities for reserve requirements. 9. Improving risk management system. 10. Introduction of more stringent capital adequacy standards. 11. Effective supervisory system. 12. Greater autonomy for banks and financial institutions.
Foreign exchange reserves. Every nation has to pay for the import of goods and services, to settle international obligations, by its foreign exchange reserves, in form of gold, dollar or pounds, which is earned by exporting goods and services. International liquidity. It is a generally accepted means of international payments available to a country for the settlement of international transactions. International reserves of a country comprise of 1. Official holdings of gold. 2. Foreign exchanges like dollar or pound, etc. 3. Special drawing rights SDRs. 4. Reserve position in IMF.
Objectives. 1. Maintenance of confidence. 2. To facilitate the intervention of the central bank. 3. To curb speculative tendency. 4. Spreading confidence in foreign exchange market. Adequacy. 1. Smooth functioning of the international monetary system. 2. Expansion of world trade. 3. Persistent inflation or deflation remains absent.
International reserves. Reserve assets other than gold started assuming more importance. Dollar and the pound sterling played very important role as key currencies. Dollar was convertible into gold and other currencies were convertible into dollar. Dollar was convertible into gold at fixed rate. There was confidence of people upon dollar being convertible to gold. The countries acquired dollar reserves by enjoying BOP surplus in terms of dollar. When rest of the world acquired dollars, US suffered from deficit in the BOP. Deficit was financed by export of gold and dollar claims by other countries. Rest of the world countries acquired huge international reserves. Problem of reserve didn't hit USA, as countries accepted dollar in lieu of gold. The volume of dollar holding of the foreigners increased. There was a massive outflow of short-term capital from USA. The BOP position of USA worsened. Ability of the USA to maintain convertibility of dollar into gold became doubtful. This led to uneasiness about the future of dollar. Dollar could not be devalued since it required cooperation of other countries. Therefore, convertibility of dollar into gold was suspended. Impose of 10% surtax on imports. International value of the dollar began to float. This resulted in collapse in Bretton Woods system.
International Monetary Fund. Composition. A 2% of national income. B 5% of gold and dollar reserves. C 10% of average annual imports. D 10% of maximum variation in annual exports. E, A plus B plus C plus D increased by the percent ratios of average annual exports of national income.
Terms. Reserve position and tranche. 1. Each member country is required to subscribe its quota. Partly in gold and partly in its own currency. 2. A member country must contribute. Gold equals 25% of its quota or 10% of its gold stock and US dollar holdings. 3. 25% of member country quota to be held by IMF. 4. It can be drawn by each member country as a matter of right. 5. Member countries' owned reserves and its drawing cannot be derived by IMF. 6. Each member country of IMF has a reserve trenched position in IMF. 7. A member may purchase up to the full amount of its reserve tranche anytime. 8. Reserve tranche can only be bought to the requirement of BOP payment. 9. A reserve tranche purchase doesn't constitute the use of IMF credit. 10. Reserve tranche purchase is not subject to changes or obligation to repurchase.
Special drawing rights. An extra source of international reserves, other than gold and dollar, to cater the growing need of international liquidity, for fulfillment of international financial obligations. 1. The SDR is known as paper gold as it is substituted for gold. 2. It is the most important international monetary asset. 3. It is a new form of international monetary asset. 4. To provide adequate reserves to member participating countries. 5. To facilitate the expansion and the growth of international trade. 6. The allocation of SDRs supplements the existing international reserves. 7. Reduces the dependency of the member participating countries on US dollar.
Special drawing account. 1. The SDR is a created deposit of the IMF. 2. It is only a book entry in the special drawing account of the IMF. 3. Allocation of SDRs takes the form of credit entry in SDR's account of the fund. 4. It does not involve any payment by the members to the fund. 5. There is no need to furnish adequate collateral security for the issue of SDR. 6. It can be freely used by the creditor country to meet its BOP deficits. 7. Participant country is not upon to adopt any specific economic policy. 8. Participant country is not upon to seek the prior approval of IMF. 9. Participant country is not required to supply its own currency in exchange. 10. To use SDRs, participant country approaches a designated member of the fund for the supply of the required foreign exchange. 11. Fund designates members provide the foreign exchange in exchange for SDRs. 12. SDRs are exchanged on the basis of strength of their BOP and reserve position.
Uses of SDR. 1. To obtain currency and transactions through agreement with other members. 2. Swap arrangements. 3. Forward operations. 4. To make loans of SDRs. 5. To settle financial obligations. 6. Security for the performance of financial obligations. 7. For donations, grants, etc.
Exchange risk. The rate at which a currency is exchanged for another currency may be uncertain, and the amount that an exporter receives in home currency or an importer has to pay in terms of home currency will be uncertain. 1. Exporter or importer creditworthiness is uncertain. 2. Country's credibility and creditworthiness is not certain. 3. No certainty about country's economic and financial policies. 4. No certainty in willingness and capacity to repay the loans or service them. 5. Fluctuations in the rate of exchange which may lead to losses. 6. Economic weakness of the country and its poor foreign exchange reserves. 7. Weakness of currency. 8. Low productivity of the country. 9. Poor competitive strength in international market.
Exchange risks types. 1. Credit risk. A risk that may arise from the borrower failing to make required payments. 2. Country risk. A risk that may arise from a country failing to make required payments. 3. Currency risk. A risk that may arise from fluctuating foreign exchange rate. 4. Market risk. A risk that may arise from financial markets and cannot be avoided.
Global linkage of foreign exchange market. The foreign exchange market is where currency trading takes place. Foreign exchange transactions typically involve one party purchasing a quantity of one currency in exchange for paying a quantity of another. 1. The market size and liquidity. 2. Market participants. 3. Trading characteristics. 4. Determinants of exchange rate. 5. Algorithmic trading in foreign exchange. 6. Financial instruments.
The market size and liquidity. The foreign exchange market is unique because of 1. Its trading volumes. 2. The extreme liquidity of the market. 3. Its geographical dispersion. 4. Its long trading hours, 24 hours a day except on weekends. 5. The variety of factors that affect exchange rates. 6. The low margins of profit compared with other markets of fixed income. 7. The use of leverage.
Market participants. 1. Banks. Trade billions of dollars daily. 2. Commercial companies. Trade fairly small amounts compared to those of banks. 3. Central banks. They try to control the money supply, inflation and interest rates. 4. Hedge funds as speculators. Currency is bought and sold, without delivery in future. 5. Investment management firms. Facilitate transactions in foreign securities. 6. Retail foreign exchange brokers. Offering the opportunity for speculative trading. 7. Non-bank foreign exchange companies offer currency exchange to private individuals. 8. Money transfer or remittance companies perform high-volume low-value transfers.
Trading characteristics. 1. No unified or centrally cleared market for the majority of foreign exchange trades. 2. Very little cross-border regulation. 3. A number of interconnected marketplaces of different currencies. 4. No single exchange rate but rather a number of different rates. 5. The main trading center is London. 6. Banks throughout the world participate. 7. Currency trading happens continuously throughout the day. 8. There are 3 sessions. A. The Asian trading session. B. The European trading session. C. The North American trading session.
Determinants of exchange rates. 1. Economic factors, distributed by government agencies and central banks. 2. Economic conditions, revealed through economic reports and economic indicators. 3. Political conditions, have a profound effect on currency markets. 4. Market psychology, market participants that impels them to buy or sell. Algorithmic trading in foreign exchange. Algorithmic trading is the process of using computers programmed to follow a defined set of instructions for placing a trade in order to generate profits at a speed and frequency that is impossible for a human trader.
Financial instruments. 1. Spot. A direct exchange between 2 currencies within 2-day delivery. 2. Forward. Money does not get exchanged until agreed upon a future date. 3. Future. Foreign exchange is bought at a specified price with delivery time in the future. 4. Swap. Exchanging currencies for certain time and reversing transaction later. 5. Option. Owner has the right but not the obligation to exchange money. 6. Exchange traded fund. Open-ended investment companies. 7. Speculation. A market for people who transfer their exchange risk.
Thank you for watching. Share this video and spread the knowledge. You can also tweet me at Nawani10.
EduWop, your one-stop solution for e-learning.